New York Stock Exchange just announced yesterday a new platform that I imagine will compete with you to some degree, a new tokenized platform. Everybody seems to be introducing all sorts of programs that frankly look a lot like things that Coinbase does. And I wonder just what you think the whole industry looks like, a year or 2 or 3 from now in terms of what you're doing relative to what everyone's doing. And by the way, at the same time that you're trying to get into everybody else's business.
Yeah. But I was thrilled to see that.
I'm not thrilled. Look, Coinbase isn't going bankrupt tomorrow, but crypto regulations could fundamentally change whether its business model still works. In this video, I'm going to tell you which parts of Coinbase's business face extreme competitive pressures if and when the crypto market structure bill passes. If you are a Coinbase investor, or if you're thinking of investing in Coinbase, you definitely want to hear this. Coinbase, as you know, is one of the biggest centralized crypto exchanges in the world and by far the biggest in the United States. For many, Coinbase was their first access point to crypto. Coinbase has transactions and subscription and service. Concerning transactions, it's the biggest side of Coinbase's revenue, making up 59% of the net revenue Coinbase has made in the first 9 months of 2025. And transactions are basically consumers or institutions using Coinbase's platform to trade assets. Whether you're trading Bitcoin for USD or whether you're trading crypto for crypto, Coinbase generates fees on these trades. Next is subscription and services. And this is the second biggest part of its business. It's approximately 41% of net revenue, but it has multiple parts. The biggest part is stablecoin revenue, where people deposit their USDC on the platform. Coinbase takes that money, invests in T-bills and other interest-bearing investments, and pays back that yield to the depositors while keeping a part of it for its own revenue. This has been a very successful business with Coinbase, and you can see how it's grown 44% just in the past year, from around 700 million to 1 billion now. And stablecoin revenue now represents almost 20% of its total net revenue. And if you remember, Brian Armstrong and Coinbase walked away from the Senate markup version, and this is why. For Coinbase, this is a non-starter, because it's 20% of its total revenue and it's one of Coinbase's fastest growing business segments. So people have to understand when looking at this, why did Coinbase just reject the bill? Because a CEO's first goal is to maximize shareholder value. Allowing that bill to pass would have been an immediate negative impact on Coinbase's market value. Next, blockchain rewards are when investors deposit and stake their Ethereum or their Solana or other staking coins through Coinbase. Coinbase stakes it for them, and whether it's 2% or 3% yield, they obviously give most of that back to the depositors, but obviously keep some for themselves. And then the smaller parts of his business that are not growing as well, the interest and finance fees, which includes margin lending, loans and financing, and other subscription and services revenue includes multiple businesses such as custodial fees. Now let's look at the red flags concerning revenue. Let's start with the biggest revenue contributor, transaction revenue, or essentially trading revenue. What has been happening in the past 2 years? One of the big phenomenons that have happened has been the introduction of spot ETFs, or spot exchange traded products. The spot ETFs gives investors direct exposure to assets that the exchange traded fund is buying. And so you think about the first Bitcoin spot ETF that was approved in January 2024. This ETF actually bought Bitcoin on the market and held it. So any investor that had the benefit of getting that exposure to Bitcoin and an approved product by the SEC. So investors, instead of going to Coinbase and buying Bitcoin and being worried about regulatory issues with that, they could buy an approved investment product, which is an ETF. This obviously reduces the value of using Coinbase to get access to Bitcoin or Ethereum or other cryptocurrencies. And we can see what has happened over the past 2 years. In January 2024, the first Bitcoin spot ETFs were approved. By July 2024, the first Ethereum spot ETFs were approved. By the end of 2025, both XRP and Solana were approved. Why is this so important? If you look at the trading revenue breakdown by asset, you will see that the main tokens that contribute to that revenue are Bitcoin at 26%, XRP at 15%, Ethereum at 12%, and Solana at 8%. In total, 61% of its trading revenue is from 4 assets. Investors, instead of using Coinbase, can just buy these ETFs on the market. In addition, these ETFs are offering staking now. Instead of having to go to Coinbase, deposit your funds, and then stake it, now you can do everything with just buying an ETF. So that's a direct competitive threat to Coinbase. Investment firms are now offering this exposure to clients. So you have Bank of America in January 2026 said that its clients now can do a 1 to 4% allocation. Wells Fargo first offered spot ETFs with its clients earlier in 2024. Citigroup take it a step further, saying that they now will offer crypto custody for assets like Bitcoin and Ethereum. With custody plus spot ETFs, people no longer need to use Coinbase at all. If you look at the confluence of spot ETFs, crypto custody, and allocation from investment firms, this threatens Coinbase's business from multiple angles, where Coinbase doesn't really have any advantage over these other firms. Next, we're going to get into tokenized securities. As we know, Coinbase has been looking to allow trading of tokenized equities and other investment assets. Well, this would directly compete with Nasdaq and the New York Stock Exchange. And as we know, both of these companies have come out and announced that they're in the process of building out a platform that would allow tokenized trading. Again, this is a direct threat to Coinbase's business model. Coinbase seemingly has no advantage over these large, centralized, regulated exchanges like Nasdaq or New York Stock Exchange. Let's look at these subscription and services. The first obvious one is the stablecoin revenue. Concerning stablecoin yields, obviously Coinbase will continue to fight this with all of its might. Ultimately, I think the banks will lose and stablecoin yields will be allowed. However, that doesn't necessarily mean Coinbase will become the number 1 player. Other companies, other institutions are going to do the same thing as Coinbase. Any of these other companies can create their own USD stablecoin per the Genius Act and also give yield to clients. And if you look at the yield that Coinbase is actually offering for USDC, it's not really that much difference from high yield money market accounts offered on USD today. The one thing I see that Coinbase is being misleading about is DeFi lending. And DeFi lending is not the same as traditional lending. With traditional lending, there's a fractional reserve and they loan out a lot of that money for unsecured loans, whether it's student loans or personal loans or mortgages. These are unsecured loans. For Coinbase and specifically DeFi lending, those are secured loans. For example, if you want to take out a loan for $5, you would have to put down collateral worth $10 and lock that collateral in a smart contract. This is not how traditional lending works. Most people who are taking out mortgages or taking out auto loans or student loans or personal loans or business loans do not have the collateral that's worth more than the loan that they're seeking. DeFi lending, yes, it should exist and customers should have that option, but we also need to keep in mind that this is not traditional lending. Banks who loan out this money to businesses, to students, for auto loans, for mortgage loans, they do play an important part in the economy. Also, from a self-interest standpoint, for Coinbase, which I understand, they are against the Clarity Act because it separates DeFi into real DeFi and fake DeFi. And if there's a centralized intermediary, then the law doesn't consider that to be actual DeFi, and that protocol will be subject to anti-money laundering, KYC, and other regulations. Base, which is Coinbase's L2, is centralized. It has a centralized sequencer, which gives Coinbase the ability to basically block transactions if it desires to. And this is totally controlled by Coinbase alone. This would not qualify as a true DeFi protocol, requiring Base to yield to a lot of these regulations. And obviously Coinbase doesn't want to do that. Base has been very profitable for Coinbase. They made an increase of over $77 million in 2024. And these were mainly the sequencer fees. In its next 10K, you're going to want to see how much money Coinbase made from Base. If that continues to increase at an increasing amount, it's more than likely Coinbase is going to fight any type of regulation that would require more regulatory oversight of Base or put more legal requirements on Coinbase. So the main point of this, and you can look back through my presentation again, check out some of the 10Ks for yourself or the 10Qs, you will see that essentially almost every part of Coinbase's business, including over 50%, concerning transaction revenue, it's going to be directly challenged by established players. Whether it's New York Stock Exchange, the Nasdaq, Bank of America, JP Morgan, crypto custody, Coinbase is literally facing competition from all of its sides. And this was the CEO's response to that.
Does it take the moat away from everybody's business? If everybody can do the same thing, what happens in the end?
Customers win with competition.
That's why you should be worried about Coinbase if you are an investor. These moves are good for crypto, but may not be good for crypto stocks. Ultimately, Coinbase has every reason to continue fighting this bill. If and when the crypto bill is passed, all of Coinbase's competitive advantages will almost disappear overnight. Focus on the fundamentals. What do you think? Let me know in the comments below. And if you enjoyed this video, make sure you hit that subscribe button and turn on your notifications. And I'll see you next time.